Before you do anything else today, I want you to understand this. What happened yesterday was not just a bad trading day. It was not just volatility. It was not just profit taking. What happened on Thursday, January 29th, was a moment where the market exposed exactly who is positioned with discipline and who is positioned with emotion. And the people who misunderstand this moment are about to make decisions they will regret for the rest of their investing lives. Today is Friday, January 30th, 2026. And right now, millions of investors around the world are sitting in silence, staring at charts that no longer make sense to them, wondering how something that felt so certain only hours earlier could unravel so violently. In less than a single trading session, gold collapsed by nearly $500 per ounce. Silver fell roughly 12% from its all-time highs. Between $3.4 and $4 trillion in estimated value was erased from the global gold market almost instantly, not over months, not over weeks, in hours. And the most dangerous part is not the numbers themselves, it's what those numbers are doing inside people's heads right now. Doubt, fear, second-guessing. The creeping thought that maybe everything you believed about precious metals was wrong. I need you to slow down. I need you to stay here with me, because what you do next matters far more than what happened yesterday. The next 24 to 48 hours will define outcomes, not the crash itself, and most people are already preparing to react in exactly the way markets punish the hardest. Let me walk you through what actually happened, without emotion, without noise, and without the narratives being pushed in real time. Then I'll explain why it happened. And then I'll tell you what this moment really represents beneath the surface. Because this was never just about gold and silver. This was about structure, liquidity, and confidence breaking at the same time. Early Thursday morning, gold surged toward $5,595 per ounce, hovering just below the 6,000 level that had become a psychological magnet for traders and investors alike. Silver pushed through $121 per ounce, printing a fresh all-time high. For a brief window, the breakout looked undeniable. Momentum was accelerating. Technical resistance was gone. Targets that once sounded extreme suddenly felt inevitable. The narrative felt confirmed. Confidence was everywhere. And then it stopped. There was no gentle pullback, no sideways consolidation, no orderly pause. Gold dropped from near 5,600 to roughly 5,100 in a single session, an almost 9% collapse in one day. That kind of move does not happen in stable markets. It happens when liquidity breaks. It happens when leverage is exposed. It happens when the market forces people out, whether they want to leave or not. Silver's move was even more brutal. From above 121, it fell to around 107 in a matter of hours, wiping out nearly 12% of its value almost instantly. And remember the context. Silver had risen roughly 68% in January alone, its strongest monthly performance since late 1979. In one afternoon, nearly a fifth of that move vanished, not because demand disappeared, but because positioning collapsed. The scale of the damage was staggering. Gold's decline erased an estimated $3.4 trillion from the value of all gold above ground worldwide. More than the entire annual economic output of the United Kingdom disappeared on paper in a single day, and I know exactly what's happening right now. Some people are convincing themselves this was the top, that the bubble has burst, that selling now is the smart move before things get worse. Others are convincing themselves this is the perfect dip. The once-in-a-lifetime entry. That hesitation equals failure. Both reactions are dangerous when they are driven by emotion instead of structure. Because this crash did not begin with gold or silver. It began somewhere most people weren't even looking. Microsoft released its quarterly earnings. On the surface, the numbers beat expectations. But beneath that headline was a problem. Growth in its Azure cloud and artificial intelligence segment showed signs of slowing. And the market didn't care about the earnings beat. It cared about the narrative cracking. At the New York Open, Microsoft shares fell nearly 12%. Roughly $250 billion in market capitalization vanished almost immediately. That shockwave spread fast. Oracle dropped sharply. Nvidia fell. The artificial intelligence trade, which had been inflating relentlessly for more than a year, suddenly looked fragile. Now here's the connection most people miss. Silver is not only a precious metal, it is also an industrial metal. One of the fastest growing sources of silver demand has been the build-out of artificial intelligence infrastructure, data centers, cloud computing facilities, advanced electronics, and high-density power systems. The same technology boom that lifted Microsoft, Nvidia, and the broader AI complex also underpinned a major portion of silver's demand story. When confidence in the AI growth narrative weakens, even temporarily, the market reprices everything connected to it. Silver gets hit from both sides. Industrial demand expectations get questioned, while leveraged speculative positions begin to unwind at the same time. A metal that looked unstoppable days earlier suddenly becomes vulnerable, not because the long-term thesis vanished, but because the short-term structure broke. But that still doesn't explain the violence of the move. For that, You have to understand what's been happening quietly in the background. Volatility has been feeding on itself. As prices rise faster and farther, liquidity thins. Banks and market makers face a problem. Their balance sheets are finite. They cannot absorb unlimited risk. When price swings intensify, they pull back, they widen spreads, they reduce position sizes, and when they step away, the market loses its shock absorbers. This is not a temporary condition, it's a structural shift. Trading volumes in precious metals have been declining as institutions reduce risk exposure. When liquidity thins, normal pullbacks turn into crashes. Normal rallies turn into vertical spikes. The stabilizing forces that once smoothed price action are no longer consistently present. That's why moves like yesterday feel unprecedented. In many ways, they are. And here's the critical part. This volatility is not going away. It is becoming the defining feature of this market environment. The same forces that created yesterday's crash will also fuel future surges. This is the new terrain. The question is not whether volatility continues. The question is whether you are positioned to survive it. Now take a step back and look at context, because context is what keeps people from making irreversible mistakes. Yes, gold fell nearly 9% in one day, but even after that move, gold remains up close to 30% year to date. At the start of January, gold was trading below $4,300. Even after the collapse, it's still near $5,100. That is an extraordinary move in less than a month. Silver tells an even more dramatic story. Despite the 12% crash, silver remains up roughly 67% for the year. It began January below $32 and surged past $100 in weeks. That kind of move is historic. Yesterday felt catastrophic because of speed, not because of position relative to the broader trend. What January 29th really revealed was not the end of a bull market. It revealed the emotional stress test that defines who survives one. And most people fail that test, not because they were wrong about direction, but because they were unprepared for what the journey would feel like in real time. Now let's talk about what this moment actually feels like inside the market, because understanding that emotional layer is where most investors either protect themselves or quietly destroy their own positioning. Right now, there are people who bought silver above $120 on Thursday morning. They didn't feel reckless. They felt confident. They believed the breakout was real, that waiting meant missing the move, and that the market had finally entered its next acceleration phase. Within hours, those same people were down more than 10%, staring at losses they never expected to see so quickly. Confusion turned into doubt. Doubt turned into fear. At the same time, there are long-term holders who had been positioned in gold and silver for months, people who watched their accounts rise steadily, who felt increasingly validated as prices climbed day after day. Those investors woke up Thursday feeling smart and patient. By the afternoon, a meaningful portion of their paper gains had vanished, and now they're asking themselves the same question investors always ask after violent reversals. Should I have sold? Was that the top? Did I miss my chance? Both groups are experiencing the same psychological shock, fear mixed with regret. The uncomfortable realization that markets can move faster than logic. This is the emotional state where the worst decisions are made, not because people lack intelligence, but because stress overwhelms process. Markets don't usually take money from people by proving them wrong. They take money by forcing emotional reactions at exactly the wrong time. So let's look at what actually happened after the initial collapse, because this is where nuance matters. Gold and silver did not continue falling endlessly. Gold found buyers near the 5,100 level. Silver stabilized around 107. The market didn't disintegrate. Liquidity did not disappear completely. Buyers stepped in cautiously, but visibly. That matters. In true bubble collapses, selling accelerates as bids vanish. What we saw instead was forced selling followed by stabilization. That distinction is critical. Yesterday was not a full abandonment of precious metals. It was a liquidation event driven by leverage, volatility, and thinning liquidity. And those events behave very differently from fundamental breakdowns. Look at what happened elsewhere in the market and the picture becomes clearer. Bitcoin fell sharply, dropping roughly 5% toward the mid-80,000 range. Major technology stocks were hit broadly. Oil pulled back from recent highs. Industrial metals like copper and aluminum, which had also surged aggressively, corrected sharply. This was not a gold and silver only event. This was a cross-asset risk-off move. When everything sells off together, it usually signals one thing: liquidity stress. Positions are being unwound not because the long-term outlook suddenly changed, but because margin requirements increased, volatility exploded, and leveraged players needed cash immediately. In those moments, assets with the largest gains are sold first. Gold and silver had enormous gains going into Thursday. They became a source of liquidity. Liquidity events have a defining characteristic. They end. Forced selling eventually exhausts itself. Margin calls get met. Weak hands exit. And once that process runs its course, markets often rebound, sometimes violently. That doesn't guarantee an immediate bottom, but it does mean panic-driven moves are rarely the final chapter. Now let's talk fundamentals, because this is where perspective prevents mistakes. The silver supply deficit did not disappear on January 29th. China is still consuming a dominant share of global silver production. Export restrictions remain in place. Industrial demand from solar energy, electric vehicles, grid infrastructure, and advanced electronics continues to grow. Central banks have not stopped buying gold. The dollar has not suddenly strengthened. Geopolitical tensions have not evaporated. None of the core drivers behind precious metals vanished in a single afternoon. What changed was positioning. What changed was leverage. What changed was confidence in a short-term growth narrative tied to artificial intelligence. And when narratives wobble, markets overreact. That doesn't mean the correction is finished. Extreme volatility creates opportunity, but it also creates traps. Just because prices fell sharply does not mean the market owes anyone a bounce. There could be additional selling. There could be another wave of margin calls. The AI narrative could face continued scrutiny, putting further pressure on silver's industrial demand story in the short term. This is where discipline matters most. The smartest approach in environments like this is observation, not reaction. Watch how price behaves around key levels. Does gold hold above 5,100 and begin to stabilize? That suggests underlying demand remains strong. Does silver defend the psychologically critical 100 level and work its way back toward 110? That would indicate the broader structure remains intact. If those levels fail decisively, it tells you the correction has further to go. Patience is not indecision. It is strategy. There are two mistakes that consistently destroy investors during periods like this. The first is panic selling. This is when fear overrides logic. People sell not because their thesis is broken, but because they can't tolerate emotional discomfort. They tell themselves they'll buy back lower. Most never do. If prices rebound, they hesitate. If prices fall further, they freeze. Eventually, the market moves on without them, and they're left watching from the sidelines. The second mistake is revenge buying. This happens when people feel they missed the rally and see a crash as their chance to finally get in. They deploy too much capital too quickly, convinced the bottom is in. When prices continue lower, they're trapped, fully invested, with no flexibility. Revenge buying is fear disguised as confidence. Both mistakes come from the same place: the need to act when uncertainty feels unbearable. Markets exploit that impulse relentlessly. One of the most important things you can do right now is preserve flexibility. Keep capital in reserve. Volatility creates opportunities over time, not all at once. The best entries usually come after multiple waves of selling, when fear has fully replaced hope. Another critical step is filtering out noise. Headlines are screaming about bubbles bursting and historic crashes. Social media is filled with certainty in every direction. None of it helps. The market doesn't reward loud opinions. It rewards calm execution. Levels provide structure when emotions are high. For gold, the 5,100 area is the first major test. Holding it keeps the broader uptrend intact. A decisive break opens the door toward the 5,000 level, which would still be a normal correction within a powerful bull market. For silver, 100 is the psychological line. Holding above it keeps the long-term structure constructive. Losing it could open the door to deeper retracement toward the $90 zone. But levels alone are not enough. Watch behavior. Does volume increase on rebounds? Do buyers step in aggressively or cautiously? These details tell you whether demand is absorbing supply or simply pausing. Now let's return to the AI narrative, because it sits at the center of this move. The AI boom has been built on expectations of exponential growth, massive capital expenditures, and relentless demand for computing power. When expectations rise that high, even modest disappointments can trigger outsized reactions. Microsoft's Azure slowdown did not end the AI revolution, but it challenged the assumption that growth would remain uninterrupted. What we may be witnessing is not collapse, but reset. Markets overshoot in both directions. A reset flushes out speculation, reduces leverage, and creates healthier conditions going forward. For silver, that matters. Even if AI growth moderates, demand does not disappear. Solar panels still require silver. Electric vehicles still require silver. Advanced electronics still require silver. The story may cool, but it does not end. Corrections like this are not the enemy of bull markets. They are part of them. The defining factor is not avoiding volatility, but surviving it. Now let's pull back even further, because this is where real clarity begins to form. Violent days like Thursday tempt people to anchor their entire outlook to a single candle, a single headline, a single moment of shock. But markets are not decided in moments. They are decided in how participants behave after the shock passes, when emotions cool and decisions carry consequences. That's where most damage is done, not during the crash itself, but in the days that follow. If yesterday's move caused real emotional distress, not just concern but anxiety, that's information you shouldn't ignore. It doesn't mean your thesis on gold or silver was wrong. It means your exposure may have been misaligned with your tolerance for volatility. Markets don't reward conviction alone. They reward conviction that is sized correctly. Even the strongest long-term ideas can become liabilities when position size forces emotional decision-making. This environment requires humility. It requires an honest reassessment of how much uncertainty you can truly handle, not how much you believe you can tolerate when prices are rising. Volatility has a way of revealing truths about risk tolerance that calm markets never expose. It's also important to understand what yesterday's crash actually represented. This was not a failure of precious metals. It was a failure of excess confidence, leverage, and crowded positioning. When prices move too far, too fast, the structure underneath becomes fragile, stops cluster, margin usage increases, liquidity thins, stability becomes conditional. All it takes is a single crack in a dominant narrative to expose that fragility. That's exactly what happened on January 29th. The AI growth story didn't collapse, but it wobbled. And when a narrative that large wobbles, markets react before thinking. Assets tied directly or indirectly to that narrative get repriced aggressively. Silver felt that immediately. Gold followed as liquidity was pulled from anywhere it could be found. But here's what didn't happen. Physical demand did not vanish. Central banks did not reverse course. Supply constraints did not ease. Monetary conditions did not suddenly normalize. The long-term pressures that have been building for years did not resolve themselves in a single trading session. What happened instead was a reminder of how modern markets behave when liquidity and leverage collide with uncertainty. And this behavior is not going away. If anything, it's becoming more frequent. The structure of markets has changed. Balance sheets are tighter. Risk tolerance is lower. Volatility is more explosive. This is the environment we're operating in now. That's why survival matters more than prediction. You don't need to call the exact bottom or top to succeed. You need to remain solvent, flexible, and emotionally intact long enough for your thesis to play out. Markets don't reward perfection. They reward endurance. For silver, its dual role remains critical. It sits at the crossroads of industrial growth and monetary stress. That makes it volatile, but it also makes it resilient. When growth narratives cool, monetary demand often strengthens. When industrial demand accelerates, investment interest follows. Silver rarely moves quietly, but it rarely moves without reason. For gold, its role has never been smooth price appreciation. Gold reflects systemic tension. It reacts to confidence breaking and reforming. Sharp corrections do not negate its purpose. They confirm it. Gold does not move to reassure investors. It moves to expose imbalance. Perspective is essential here. On short-term charts, yesterday looked catastrophic. On weekly charts, it looks like a violent reset. On monthly charts, it appears as a sharp but contained pullback within a powerful uptrend. Time frame changes interpretation, and interpretation drives behavior. Another critical lesson from this moment is the danger of certainty. When markets feel obvious, risk is usually highest. When markets feel confusing, positioning quietly resets. Right now, confusion dominates. That alone should give you pause before making impulsive decisions. The AI narrative will continue to evolve. Expectations may moderate. Growth may normalize, but the structural demand drivers tied to energy transition, electrification, data infrastructure, and monetary instability remain. Short-term narratives fluctuate. Long-term pressures persist. This is why reacting emotionally to a single day can be so costly. Selling into fear or overcommitting into uncertainty creates outcomes that are hard to reverse. The market will move again, whether people feel ready or not. The question is whether you'll be positioned calmly or reacting desperately. Volatility is not a sign that something is broken. It is the mechanism by which markets test conviction. It is uncomfortable by design. If holding through days like Thursday were easy, everyone would do it. The difficulty is what filters participants over time. Some investors will walk away after this, convinced they were wrong. Others will overextend themselves, convinced they're smarter than the market. Both responses miss the point. The goal is not to feel certain. The goal is to remain resilient. Resilience means having a process before chaos arrives. It means knowing where you'll wait, where you'll act, and where you'll reassess only if facts change, not emotions. It means accepting that drawdowns are part of the journey, not evidence of failure. January 29th was a test, not of intelligence, but of temperament, and these tests will continue. This market environment will keep challenging confidence, shaking conviction, and punishing emotional reactions. Gold fell nearly $500 in a day. Silver dropped 12%. Trillions in value evaporated on paper. And yet, nothing fundamental about the global monetary system was resolved. Nothing structural was fixed. If anything, the conditions that created this volatility are becoming more deeply embedded. This is what real bull markets feel like from the inside. They are not comfortable. they are not reassuring. They are volatile, uncertain, and filled with moments that force people to question themselves. The winners are not the ones who feel no fear. They are the ones who refuse to let fear make decisions for them. So take this moment seriously, but don't let it define you. Use it to refine your process. Reassess your exposure. Strengthen your discipline. Because markets will move again, violently and without warning. And when they do, the people who remain calm will already be positioned while everyone else is still reacting. Volatility is the test. How you respond now determines whether you pass it.